Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time with his good friend, Mr. Dan Bird. How you doing, sir?
I'm doing great. How are you?
I'm doing well, man. I got to tell you, I'm a little nervous. I
Should
am
be. You
A,
should be.
yeah, exactly. I should be. So I'm going to be doing something I haven't done in years. Probably, I traded very little during the Great Recession. I bought some Citigroup, some Blackstone, and one other, but I was out of them.
Cisco.
Yeah, Cisco probably. I was out of them very quickly. Made some money. Other than that, I haven't bought a stock, haven't traded in like forever. And something that, again, if people watch my channel, you and I started talking about 2 or 3 weeks ago, you're going to help me be non-emotional with trading. My great flaw is I get emotional, right? And that is horrible when you are trading. So I thought what we would do is I would come and learn from you. Again, we call it like learning a language, this technical trading. So we're going to talk every week, and we're going to talk about how to do technical trading. We potentially do some trades. And again, this is all for learning. I'm letting the audience watch me learn. And if they happen to learn something, that is great. But does that make sense?
Yeah, by the way, what goes hand in hand with emotional trading is confirmation bias.
Yes, for sure.
And that's the thing that usually gets most people. They believe the market is going to go up, or they have a feeling that the market's going to go up. And then they look for every confirmation that they can that they're right. And I mean, a great example is this guy that I really respect. That's a great trader. Back when the pandemic started, he said, buy Zoom. And Zoom went to the moon practically.
Yep. Yeah, you got that one right.
So he was right. And then as Zoom started coming down, he kept giving reasons why, oh, it came down to this level. Now it's going to
buy it again. Buy it again.
And he did. And it came down to the next level. And he said, it's going to rebound here.
Nope.
So he almost gave back everything he made on Zoom because of confirmation bias.
Yeah.
He was convinced that Zoom was going to continue going up, and he was ignoring the signs that it was going down.
Yeah. Yeah, well, this is going to be learning for me. And again, one of the things people need to go back and watch our past videos that we are going to be doing if we trade. We're not going to trade every week, but if we set up a trade, you will see us put in floors to protect our downside. That is something I never did before. And you're going to help me understand. So we always start our discussions. Interview number 1, you have a weekly newsletter that if people have interest in learning or reviewing what's going on, you put together that people can ask for. If they want to see it, what's the email they should ask for?
Let me share my screen.
Thank you.
Can you see it there?
I can. I always get this wrong, so let me get it right. breakpointtrading@gmail.com. Hey, I got it right.
That's right. So break point is the point where the stock breaks out.
Yeah. So again, if you want to see this, you want to see the weekly newsletter, just email breakpointtrading@gmail.com saying, hey, I saw you on one rental at a time. Love to get the weekly newsletter. It is free. And he will add you to the list. And if you don't want it anymore, just tell him you don't want it. You'll be taken off the list. Is that fair?
That's exactly right. Yeah.
Awesome.
I just do it. I do it for myself more than anything. But.
Yeah, you do that. It's pretty much like what I do every morning. I've been reading about the consumers for 30 years, and now I just take notes and talk to a camera. So I get it. I understand the newsletter. So let's pull up the newsletter and see what made the cut this week.
Actually, I haven't done it for this week yet.
Oh, okay.
I'm going to do it right after this call.
All right. Then what do we got in the newsletter, you think, this week?
This right here, see the IBD confirmed uptrend. It's going to be uptrend under pressure.
Ooh, okay.
So, and I'm going to actually, let me show you what I'm going to talk about.
Awesome.
Let me close this one. And look at this one. I put this in LinkedIn yesterday. So the chart on the top is the CPI. The CPI numbers come out on Wednesday.
Wednesday, yep.
Right.
Estimates are 7%.
Right. So right now it's 5, a little over 5, or 6.8, I think.
6.8. 6.8 was last. I actually did the math, actually doing rent correctly, and it's 10%. But the government doesn't want to hear that. But yeah, last report was 6.8.
Yeah. So here's a CPI over the last 20 years.
Okay.
All right. Now, one interesting thing about CPI, and as a real estate guy, the rule of 72s.
Mm-hmm. Yep.
Right.
Oh yeah.
So if we stick with an average that the Fed is trying to maintain, which is 2%
Mhm.
inflation per year,
Mhm.
how long does it take to double the price of everything? you
About
buy?
36 years.
36 years, everything's going to double. So no matter what, inflation, and that's why people say, oh yeah, but if I do an inflation adjusted dollars going back to 1970,
Yeah.
yeah, but you can't really do that
Yes. It's
because
Yeah.
it's inflation is here and 2% is
Yeah.
standard inflation. 2% means everything you buy is going to double every 36 years.
Yep. Rule of 72.
Period.
Yep.
So if it's at 6%, how long will it take everything you buy to double?
12 years.
12 years. That's right.
Yeah.
So this is 20 years right here. This is standard inflation. What you can see down here is I put a rate of change on this at the bottom.
That's a month-on-month rate of change.
This is a month on month because the CPI comes out every month,
Understood. Yep.
right? So this is, and in fact, these little bars right here represent 1 month because
Got
that's
it.
the only way, that's really the only way you can represent CPI.
Yeah. It's not a, it's a point in time number. Correct.
That's right.
Yep.
But the interesting thing is here, CPI has not had, over 20 years, has not had more than a 3% rate of change.
Yeah. I did a 50-year spreadsheet. So yeah, if you go back 20 years, yes, that's correct. Yes.
Right.
Mhm.
So what you can see right here is in April of last year,
Mhm.
April of 21, is when it broke out above that standard 3% that it's been at for 20 years or more.
Yeah. So we're almost a year into this thing, almost.
Right.
8 months into it. Yep.
Almost a year. And you can see the exponential growth. This is
Yeah.
a zoomed in view,
Mhm.
the 2-year CPI down here.
Yeah. It takes the trend line gets pulled higher and higher. Yep.
Right.
Mhm.
Now, what's interesting about the CPI number is that it is calculated each month on a rolling 12-month.
Yeah. They talk about the seasonality. Yeah. Because they call it the base effect. Yes.
Right.
Yeah. And that's what's
So
going to catch people. Yes.
that's what's going to scare a lot of people,
I
especially
agree.
with the CPI that comes out on Wednesday.
Yeah. Because the base effect is
Yeah,
starting to
because
adjust up.
so let's say it's 7%,
Mhm.
but it's a 12-month rolling.
Mhm.
So 12 months ago it was 0%.
Mhm.
So the 0 is going to drop off,
Oh,
being
yes.
replaced by the 7,
Yeah.
right?
That's going to have an impact. Yeah. Yeah.
And that really will not catch up until probably the April or May CPI report. In other words, the big bump that happened last year
It might be July. Yeah.
might be July, but the big bump, the big huge bump, the 3-month bump, if you look at each month,
Mhm.
the 3-month bump happened about last May,
Yeah.
April, May timeframe.
No, I agree.
So,
Yes.
so those will begin to drop off,
Correct.
right?
Yeah. But we've got
So
3 more months of the base effect being the other side of that. Yes.
That's right. That's right. We've got 3 more months of pain.
Correct. I agree.
Right. And that is going to become clear on Wednesday.
So, I mean, I know, I know if you don't want to make a call, it's fine. But something I do on my channel this morning is I said the over under is 7%, which is actually what the talking heads are calling. And I took the over, and then I actually put out 7.2 as my wild ass guess. Any thoughts on that?
No, I don't like to predict anything.
Okay. All right.
But
Do you want to play
you
over
know,
under?
I don't think you're off.
Okay.
I think it will probably be over
Yeah.
the 7%.
Fair enough. I like to play games. I like to put numbers out because once in a while I nail it and I go ha ha ha. But anyways,
The more important thing is that those same talking heads
Mhm.
will be yelling and screaming and creating panic in the market.
Oh, I agree. Yes, I agree. Wednesday is going to be an interesting day. Wednesday, the PP or CPI comes out, I think at 6 a.m. Might be 5:30. I think it's 6. That's 6 a.m. Pacific time.
Right.
Yeah. It'll be an interesting day.
So again, this is another way to use charts
Okay.
to identify where things are changing.
So again, what you're really telling me and really the audience here is you're not only looking at what's going on in an individual stock or an individual sector or an individual index. You are taking into account macro factors as well.
Yeah. You start at the high level and you work your way down. So macro factors, the economy,
Okay.
then down to the index, then down to the sector, then down to the industry, and then finally the stock.
I think that is so wonderful that you said that. I may ask you to say it again, because a lot of the people out there that are in YouTube world, they love to stare at the daily charts, the minute charts, and they're going the other direction. They're talking, they're like, oh, look, it's breaking out, this candlestick and blah, blah, blah. And in reality, that probably makes really good viewership on YouTube. It probably is a very dangerous way to trade, or it is a very dangerous way to trade. You have to start macro and go down, not bottoms up.
So let me make a comment on that.
Sure.
It's not necessarily a dangerous way to trade.
Okay.
If that's how you trade.
Gotcha.
But you need to know what is best for you.
Oh, I like that. Okay.
If you're a daily trader and you look at the 1 minute candles, and these charts, by the way, work on any time frame.
Yeah.
They work on weeklies and month. This is a monthly chart.
Right.
They work on monthlies, weeklies, all the way down to 1 minute charts.
Mm-hmm.
And they will work the same way, but you have to know what you're best at.
Perfect.
So if you're looking at 1 minute charts, you have to know that you're in and out of the trade by the end of the day.
Yeah, you have to right side your charts with your trading behavior. You're not a long-term holder looking at minute charts.
That's exactly right.
I like
it. If you're a long-term holder, you're looking at weekly charts.
Okay, perfect.
Right. So you need to know who you are. And that's probably one of the most important things in trading. It goes back to what I talked about, confirmation bias.
Oh, I love that.
You have to understand your own psychology.
Okay. Awesome. So I am not,
and no one else can do that for you.
No, that has to be an individual. So let me just say it right now. I will never be a daily trader. I am not going to be, I will not look at these charts except when you and I talk every Sunday. I'm a long-term hold guy. So when people are wondering why we're not doing daily candles and all that nonsense, it's because that's not who I am. And that's not what I choose to learn. So yeah, that's very cool. So thank you for that. All right.
Let's see what we've got here. Let me look at one other thing. Maybe two other things.
Okay.
Let's look at the 10-year treasury.
Oh, I look at this every day. I look at the 10-year every day.
So you know then that it is now at a 52-week high.
I do. Yeah, 1.72 or 76 or 77. Yeah.
Yep.
Yep. Mm-hmm.
Yeah. 1.76.
Yeah. It's a 6677, whatever. Yeah.
So if we put that in a chart to give us some perspective, there's the S&P down below. Here's the COVID recession.
Yeah. There's the shutdown. Yep.
Here's the inverted yield just before the recession.
Mm-hmm. Oh yeah.
Which many times happens.
Yeah. Calls a recession. Yep. Mm-hmm.
Right. There's the inverted yield. The two
is 2 and 10.
The 10.
Yep.
Right.
210. Yep.
Here's the 2 down here, and here's the 10 up here.
Mm-hmm.
And you can see that the 10 was coming down, but now it's spiking.
Yeah, I think they're going to. I think you're going to see that widen. I think.
Right.
Okay. Which is, oh, by the way, really good for banks.
Exactly.
Yeah.
Really good for banks. Now, the other thing I'll point out, and we talked about this before, but normally when the 10-year yield and inflation is on the horizon, gold starts to take off.
Yeah.
Right.
Yeah.
And bonds go the opposite direction. Bonds should be at the bottom when the 10-year is going up.
Interesting.
This red line is core CPI, by the way.
Understood.
So,
yeah. Okay.
So right now the market doesn't really seem to be too concerned, and I think the reason for that, and they might get more concerned after Wednesday.
Yeah.
But the reason I don't think the market is overly concerned is because they understand that rolling 12-month window.
Yeah.
They understand that after April or May, then that 12-month window will start to show inflation coming down. And yes, we'll probably get a rate increase in March, and we may get one more.
We will.
But by the summertime, the inflation's going to start to come down, and the Fed's going to say, great, we did our job.
Yeah. Yeah. You can already read the Fed's playbook, right? We're going to raise in March. April inflation will peak in either March or April. It will start to roll over. Then they'll point at their interest rate rise. Say, look, we did that. No, you didn't do that. The base effect change, you cheaters.
Exactly. That's right.
I agree.
But the talking heads will run with it.
Of course.
Story, and they'll create fear and panic in the market, and the market will crash.
Okay.
And then the last one that I like to look at all the time is the VIX.
Okay.
The VIX is the fear index.
Yes.
You can see down here, this is the S&P. The S&P been going down for 3 days, went down big time right here.
Yep.
However,
that Fed meeting minutes Wednesday afternoon. Yep.
Yeah, that's right. Exactly. Fed meeting minutes went down. But interestingly, the VIX did not spike. As a matter of fact, on Friday, you can see it right here at the end in the gray one. The gray one is the actual VIX number. The other two are moving averages. So this is a 5-day and a 21-day.
Yep.
Just so I can see where they cross, because that's the inflection points.
Got it.
It hasn't crossed, but you can see in the gray area, it's still not spiking. In fact, on Friday, even though the market went down on Friday, the VIX also went down. Normally the VIX goes up when the market goes down.
So what do you think that means? That's different.
Again, I don't think the market is overly concerned, but I think that on Wednesday this is going to start spiking.
Yeah, I think Wednesday's going to be interesting. Yeah. Okay.
Right.
All right.
And
so,
by the way, what you like to see, what you want to see, is for the VIX spiking up here near 30.
Yeah, that's blood in the street. People running,
That's
dumping.
blood in the street. Everybody's selling. Get out. That's the time to buy. If you follow this down here, it was right at the bottom.
Cool.
Follow this spike down here. It's right here at the bottom.
Yeah. Okay.
So I like watching the VIX too, just to see what the sentiment of the market is.
Well, very, very cool. You know, one thing I just want to say here, if you get a chance, and probably after the markets are closed, if the VIX ever pops really bad, send me a text or something so we can maybe do a one-off evening show. Obviously, that doesn't happen very often, but otherwise we'll just talk every weekend. And again, we talked off camera. We're actually talking about doing 2 trades this today.
Yeah. One thing on that topic, one thing that I created is what I call my bottom finder.
Oh, okay.
And this combines the VIX, the quit call index. It's a busy chart, but you know, again, I know French, so I can read it.
Yeah. This is what I hope to pick up over time. This is some
gray mountainous area.
Real quick, folks. Sure. Again, I'm learning French. Again, using our analogy, Dan understands this at a moment's notice. I do not understand this chart at all. So if you're looking at this going, I don't get it, myself, Mike Zuber, doesn't get it yet. But that's why we're going to come back every week and get a little bit better, a little bit better, a little bit better. So sorry about that.
Yeah, this gray area here is the percent of stocks above their 50-day moving average.
Oh, okay.
You can see when it goes way down, that's usually the bottom. One thing that concern, and these blue lines here is where I identified the bottom to get back in.
Got it. Oh, those are okay.
The thing that concerns me is that 50-day, the number of stocks above their 50-day has really not gone down yet, even though the market has. So the bottom is not in yet.
Right.
So we'll see what happens on
I see
Wednesday.
what you're saying. Okay. All right. I'm excited.
All right.
All right. So why don't we just tell people the 2 things that we're going to put trades on, and then we will right size it, put a floor in, all that to protect me. We're going to do a financial, because we think that rates are expanding, which I totally get, right? It's not going to invert, it's going to expand. So we're going to play in financials. And then we do expect NASDAQ to have some more pain. So we're going to double up in one of the indexes. That's a 2 times, right? Those are the things we're thinking about.
It's an inverse ETF.
Inverse double, right?
So it goes up when the market goes down.
Right. Correct. Yep. All right. So anything you want to say about those 2 before we close out of this episode, and then we bring up your
we can yeah, we'll bring up your, do you want to go into your account, show, and actually execute the trade?
We'll do that in video 3s. Very important for me, and then the audience to watch, is how we right size the trade. We agree on a floor. We don't let emotion drive that. So I want that to be video 2.
Okay. I mean, that's all part of placing the trade.
Oh, okay.
We can do them both together. Okay.
All right.
And we can place the trade and then remove it before Monday or before the market opens if we want to on Monday.
Nah, this is a learning experience. All right. You want to bring
let's do both of those together.
Okay.
Both should be done together.
We'll do that then. All right. Very cool. Thanks, bud.
All right.